can't know the solution if you don't know the problem. And the problem, of course, as we've discussed in so many iterations, and we can bring out all the data, it's not just sensational, is we have a massive, unsustainable global debt crisis. Holding your precious metals and your store of value, which is a better store of value than any paper currency outside of that banking system, made sense in 1995 and 2003, and it makes sense in 2025. Because if you understand the problem, you have the conviction that this store of value, this silver or this gold that I own, is only going to go up further in a secular manner, not a straight line. It's only going to go up further in a secular manner because there is no immediate solution.
Thousands of years ago, gold has been one of the main ingredients of human society. The world today is witnessing the transformation of the global monetary system by the central banks by means of strategic accumulation of gold. This reflects the greatest reallocation of reserve assets in the history since the crash of the Bretton Woods system in 1971. This transition is not a one-time policy adjustment. Rather, it is a structural transformation of the global economic relations. Matthew Piepenburg of Von Greyerz points out that gold is not increasing due to market hype. Rather, he points out that it is due to the gold going up as the fiat money is in a bear market. Debt, in other words, when paper currencies decline in value because of the unsustainable debt, gold maintains wealth. Weakness of the present financial system is obvious. The U.S. national debt has grown to over $38 trillion or more than 120% of annual economic production, and the country now spends approximately $1 trillion annually only in having to pay the debt, or rather in servicing the debt exceeding the expenditure placed on defense. The recent activities of the U.S. Treasury, such as the $1 trillion Treasury General Account financing, generate lots of cash flow volatility to shift the liquidity between the Federal Reserve accounts and the banking system. These forces create market strains and reveal vulnerabilities in the international financial structure. Piepenburg perceives a sovereign debt crisis to occur on the global scale and not only in the U.S. He recommends gold to secure wealth, as he says, "With gold, it is always easy, owing to the fact that debt never varies and a debt meltdown that is due to a sovereign debt crisis worldwide." He is of the opinion that the price of gold would rise to surpass $4,800, $5,000 or even $6,000, as there is no immediate remedy to the global debt crisis. Gold is no investment, it is an insurance against the fall of paper money. Let's dive into today's video to uncover some valuable insights. Don't forget to subscribe and hit the notification bell so you never miss an update.
Holding your precious metals and your store of value, which is a better store of value than any paper currency outside of that banking system, made sense in 1995 and 2003, and it makes sense in 2025. If you understand these core issues, whether you bought gold at $1,600 or $2,800, or whether you buy gold when it gets to $5,200, you'll still understand why you bought it. And I think the simple answer is if you can't know the solution if you don't know the problem. And decades ago, Egon and many others, and myself later, understood the problem. And the problem, of course, as we've discussed in so many iterations, and we can bring out all the data, it's not just sensational, is we have a massive, unsustainable global debt crisis. It has been percolating pre and post COVID. It's been percolating pre and post 2008. When you have a debt crisis, wherever your zip code is, whatever your central bank is, whether it's the ECB, the Bank of England, whether it's the Fed, central banks from Australia to DC will monetize that unsustainable debt with money created literally ex nihilo, out of nowhere, expanding credit, expanding the money supply, and debasing the currency. That's a very simplistic understanding of the problem, that currency will be debased over the long term. The inherent purchasing power of your paper currency, whatever currency that is, certainly the home of the world reserve currency is important, that whatever that currency is, it will lose its inherent purchasing power over time, as it has done, again, from ancient Rome to Philip II in Portugal in the 1500s, to the British Empire, the Dutch Empire, the U.S. Empire. Again, doesn't mean the end of all of these empires, emphatically, Rome is still there, DC is still there, London is still there, but the purchasing power of those currencies and of those hegemonies inevitably debases itself because of the addiction to easy money and the addiction to debt to stay in power, whatever power that is, whether it's democracy or not. You need to spend. When you no longer have a chaperone to that money or that currency, whether it's a denarius or a dollar, you whittle away at the precious metal aspect. You decouple it from the gold standard, which is literally in Article 1 of our Constitution, and then you can go into greater debt, and that you can debase your currency. So again, simplistic historical lesson, but if you understand precious metals as a store of value, not a NVIDIA stock, not Anthropic, tech trade, not Tesla, whatever other asset that has made you rich or poor in the last 20 years, depending on your entries and exits, if you understand gold and silver as a better store of value to preserve your wealth against debased paper money, if gold goes down 10% in a 2-week period in these recent all-time highs, that doesn't bother you at all, because if you understand the problem, you have the conviction that this store of value, this silver or this gold that I own, is only going to go up further in a secular manner, not a straight line. It's only going to go up further in a secular manner because there is no immediate solution to the problem of debt. Again, we've talked about debt in 80 different ways, but it's nothing new throughout history. Sometimes history, again, is harder to see when you're in it. But no, as always with me, it's a long answer to a short question, but no, it is not a surprise to see gold going back up again. It will not be a surprise when it passes 4,800 or 5,000 or 6,000, only because this is not a bull market in precious metals. It is a bear market in paper money. You either believe that or you don't. You either accept that or you don't. We can spend a lot of time, and we have spent a lot of hours over the years talking about this. That's a personal choice. You should take your own informed judgment on that, but I think the evidence, which we can get into too, is fairly obvious that the world is catching on after decades of overextending debt levels to such a degree. It can be done for a while, but it's gone to that tipping point. It's like boiling water. It gets very hot for many, many minutes, and then at some point, it starts to boil.
The past few months have shown that there have been cracks in the engine of the banking system. Fundamentally, repo funding costs have been inflexibly high in the U.S. The repo rates have been above the target range recently, as liquidity tightened towards the end of the year. Meanwhile, the central banks of the world are quietly accumulating gold to the point that by 2025 they already stocked over 630 tons of it by Q3, way beyond the levels of the previous year. This is no accident. With fiat currencies and debt instruments shakily adapting to mounting pressure, institutions are exploring gold as a stable store of value, an insurance against currency debasement, liquidity pressure, as well as a failed financial plumbing. Piepenburg is of the opinion that these red flags are not merely numbers, rather they are indications that precious metals have been and are one of the most effective methods to hedge wealth in a shaky, debt-filled financial system. Now let's jump straight into the content.
It's very simply saying that there's less and less liquidity in the banking system. There's less and less trust among the banks. There's less and less oil in the engine. That engine is so critical to the U.S. banking system, which is so critical to the global banking system, which is so critical to U.S. Treasury purchases, and so critical to derivatives trades, which are collateralized by U.S. Treasuries like the repo markets. I'm grossly simplifying, but you don't need to get into the complex to basically understand when you see repo rates surpassing the Fed funds rate, that's a sign that A, banks are losing trust, and B, there's a liquidity problem. And what that has to do with gold, of course, is to go to the reverse repo facility to bail out the repo markets, to bail out the banks that use those markets, is really just QE by another name. And so QE, of course, is printing money out of nowhere to provide liquidity. That's expansion of credit. That is indirectly an expansion of the money supply. Inflation is the measure of the expansion of the money supply. And when inflation, however it's misreported by the CPI scale, increases because of currency debasement through expansion of the money supply, that's usually and always a tailwind for an anti-fiat instrument like precious metals in general and gold and silver in particular. So these little tiny corners of the Wall Street world, which are the reverse repo markets and the repo market and the overnight markets, are again not on the water cooler conversations of your average conversation at work. It's not what you talk to your wife with a coffee at breakfast. It's usually not the first conversation at a football game or a golf outing, but it's there. It's ticking in plain sight, kind of hiding in plain sight. It's very much misunderstood, but the ripple effects of spiking repo rates can be very, very dangerous. And again, 2019 was an extreme example. We're not at those rates now, but the fact that we're there is no shock. We've had Powell trying to tighten the balance sheet all year, keeping rates low, but clearly, as of December, there's clearly a sign from the repo markets. It's on that dashboard of your car. It's a symptom that liquidity is tightening. When credit tightens in a world that is supported by easy credit or debt, when you start to see warning signs on the dashboard like that, this far into a debt cycle where we're literally at 38 trillion in public debt, where we're projected to have 50 billion. This Congressional Budget Office says 50 billion by 2033. When you see that kind of debt and that sustains us, and then credit markets tightening in those debt markets or lending tightening, and we see it in the subprime markets, we see it in private equity and private credit pools, we're seeing little symptoms all over the place of credit tightening in a world so enamored and so survivable by debt. To see these type of warning lights, whether it's at the repo markets, and we can talk about the private equity markets, the private credit markets, this is not a good sign in an already world full of bad signs from Main Street to Wall Street. So again, these simple little repo rates are a screaming indication that credit is tightening, liquidity is becoming drier. Boy, those are shark fins in a market sustained by debt like this. That's the simple answer. And of course, the solution will be mouse click money, fire hose money, helicopter money, whatever you want to call it, bazooka money. That's typically a tailwind for precious metals, which already have so many tailwinds on their backs as it is. It's just one more, bull case for gold. Again, I'm a gold guy, but I'm not doing data mining. This is a data analysis. In my mind, it's just another warning sign.
The central banks of the international countries are plotting to abandon the dollar, though since there is no one substitute to the US currency, they will purchase more euros, the China yuan currency, and additional gold. The hot run of gold that saw the metal rise to records may carry on well into 2026. That is what, according to forecasters on Wall Street, a large number of them are anticipating the precious metal to proceed with its record-breaking surge and rise up to 20% in 2026. A consecutive rise of gold in the two digits would be quite an uphill task, bearing in mind that this year, bullion has recorded one of the best performances in decades. Gold has already recorded a 57% rise in 2025 year-to-date. How confident are you that fiat currencies will maintain their purchasing power over the next 10 years? We'd love to hear your thoughts in the comments below. If you enjoyed this video, give it a thumbs up and make sure to subscribe for more updates. Thanks for watching.